but Enron was once the 7th largest corporation in America. They revolutionized trading and the energy market. They were far smarter than their competitors, and their business was intricate and too complex for the average person to understand.
In the late 1990s, a Houston-based energy company stood as one of America's most admired corporations, boasting annual revenues exceeding $100 billion. By December 2001, that same company filed for bankruptcy, wiping out over $40 billion in shareholder value and destroying the retirement savings of thousands of employees. This is the story of how Enron, once celebrated as the most innovative company in America, became the most notorious corporate scandal in history. Enron began in 1985 when Kenneth Lay merged two natural gas pipeline companies, Houston Natural Gas and Internorth, into a multi-billion-dollar enterprise. At first, the company operated as a traditional energy supplier, transporting natural gas through thousands of miles of pipelines across North America. But Lay had bigger ambitions than simply moving gas from one place to another. The turning point came in 1990 when Lay hired Jeffrey Skilling, a brilliant consultant for McKinsey & Company. Skilling arrived with a revolutionary vision that would transform Enron from a boring pipeline operator into what he called the stock market for natural gas. His idea was simple but radical. Instead of just delivering energy, Enron would trade it like stocks and bonds. Skilling's plan required a new way of accounting, and he pushed hard for something called mark-to-market. This accounting method allowed Enron to record the total value of a long-term contract as profit the moment it was signed, rather than waiting to collect actual cash. For example, if Enron signed a 20-year deal to supply electricity from a power plant still under construction, the company could immediately book all projected future profits. Even though the plant hadn't generated a single dollar of revenue, the Securities and Exchange Commission approved this approach for Enron in 1992, opening the door to creative manipulation. Mark-to-market gave Enron a dangerous tool. The company could inflate projections of future earnings, making itself look incredibly profitable on paper, while reality told a different story. When projects failed or revenues fell short of expectations, Enron simply moved those losses off its books through a network of partnerships and shell companies. The reported profits soared, the stock price climbed, and Wall Street analysts praised the company's innovation. In 1996, Skilling recruited Andrew Fastow as Enron's chief financial officer. Fastow took the deception to new heights by creating hundreds of special-purpose entities, shadowy partnerships with names like LJM, Chuco, and Raptor. These entities existed almost entirely on paper, many of them registered in the Cayman Islands to avoid scrutiny. Their purpose was simple: hide Enron's mounting debts and create the illusion of financial health. Fastow's schemes were breathtakingly complex. He would set up a partnership using Enron stock as collateral, then have Enron sell underperforming assets to that partnership at inflated prices. This allowed Enron to book profits while keeping the losses hidden in an entity that didn't appear on the company's balance sheet. In one deal, Fastow arranged for Enron to sell an interest in Nigerian barges to Merrill Lynch, with a secret promise to buy them back at a guaranteed profit. No real business occurred. It was pure accounting fiction. The audacity of the fraud extended to Fastow's personal enrichment. He secretly made $45 million from these partnerships, while serving as Enron's chief financial officer, a staggering conflict of interest that should have raised immediate alarms. His compensation came from deals he arranged between Enron and entities he controlled, allowing him to profit on both sides of transactions. He disguised some of this money as gifts to family members in amounts just under $10,000 to avoid reporting requirements. Throughout the 1990s, Enron's stock soared. By August 2000, shares traded above $90, and the company's market value exceeded $60 billion. Fortune magazine named Enron the most innovative company in America, 6 years in a row. Employees were encouraged to invest their retirement savings in company stock, assured by management that Enron's future had never looked brighter. But beneath the gleaming surface, the company was rotting. Enron's international ventures were failing spectacularly. A massive power plant project in India turned into a financial disaster. Investments in fiber optic networks and water companies hemorrhaged money. The partnership with Blockbuster to deliver video on demand, announced with great fanfare, collapsed without earning a penny. Yet Enron had already booked $53 million in projected profits. Skilling fostered a cutthroat culture inside the company where employees were ranked against each other, and the bottom performers were fired. The pressure to meet Wall Street's expectations became overwhelming. Executives manipulated California's energy markets, deliberately causing blackouts to drive up prices and boost profits. At one company meeting, Skilling joked about the California energy crisis, mocking the state even as Enron traders plotted to keep electricity prices artificially high. The web of lies required constant maintenance. To keep the stock price inflated, Enron had to continuously sign new deals and create new partnerships. Each quarter became a scramble to report earnings that would satisfy analysts. The company operated on a quarterly basis, lurching from one reporting period to the next without any sustainable long-term strategy. By mid-2001, cracks began to appear. A Fortune magazine article questioned Enron's impenetrable financial statements, noting that analysts couldn't understand where the company's profits actually came from. Short sellers started betting against the stock. In August 2001, after serving as chief executive for just 6 months, Skilling abruptly resigned, claiming personal reasons. He immediately began selling his shares, unloading nearly $60 million worth of stock before the collapse. Kenneth Lay resumed the role of chief executive and tried to reassure nervous investors. During a conference call on August 14, 2001, he declared that the company had no accounting issues, no trading issues, and no previously unknown problems. He claimed Enron was in the strongest shape it had ever been. It was a complete fabrication. In October 2001, Enron announced a loss of $618 million for the third quarter and revealed that it had overstated income by nearly $600 million since 1997. The Securities and Exchange Commission opened an investigation. Credit rating agencies threatened to downgrade Enron's debt. Banks refused to issue new loans. The stock price went into freefall. Rival company Dynegy briefly offered to acquire Enron, but the deal collapsed when the true extent of the financial disaster became clear. On December 2, 2001, Enron filed for bankruptcy. At the time, with $63 billion in assets, it was the largest corporate bankruptcy in American history. The stock that had traded above $90 18 months earlier was now worth 26 cents. 25,000 employees lost their jobs. Many lost their entire retirement savings, which they had been encouraged to keep invested in Enron stock. Shareholders who had trusted the company's reported profits saw billions of dollars evaporate. The accounting firm, Arthur Andersen, which had certified Enron's fraudulent financial statements and destroyed documents during the investigation, lost its license to audit public companies and effectively ceased to exist. Federal prosecutors assembled the Enron Task Force, conducting over 1,800 interviews and analyzing more than 4 terabytes of digital evidence. 22 people were convicted for their roles in the fraud. Andrew Fastow pleaded guilty to conspiracy and securities fraud, agreeing to cooperate with investigators in exchange for a reduced sentence. He served 6 years in prison and forfeited over $23 million. Jeffrey Skilling was convicted on 19 counts of conspiracy, fraud, and insider trading. He was sentenced to 24 years in prison and fined $45 million, though his sentence was later reduced to 14 years. Kenneth Lay was convicted on 6 counts of fraud and conspiracy, but he died of a heart attack before sentencing. The Enron collapse sent shockwaves through the financial world and led directly to the passage of the Sarbanes-Oxley Act in 2002, which imposed stricter regulations on corporate accounting and increased penalties for financial fraud. The scandal became a textbook example of what happens when greed, ambition, and deception go unchecked. Today, Andrew Fastow speaks publicly about his crimes, acknowledging that while he found ways to technically comply with accounting rules, his actions were unethical and caused real harm to people. Jeffrey Skilling, released from prison in 2019, still maintains his innocence. The Enron scandal proved that no company is too big to fail, and that even the most sophisticated financial schemes eventually unravel. It remains a powerful reminder that corporate success built on lies and manipulation, will always collapse under its own weight, leaving destruction in its wake.